The unprecedented demand for artificial intelligence has ignited a fundamental shift in market dynamics. While headline-grabbing AI applications capture public attention, a critical underlying truth emerges. The foundational infrastructure powering these advancements is demonstrating superior market performance. This divergence reveals a deeper, more sustainable investment thesis. The current market landscape shows AI infrastructure companies consistently outperforming their big tech counterparts. This phenomenon stems from the foundational role these companies play, providing the essential hardware and services that enable the entire AI ecosystem. As AI capabilities expand, the need for robust, specialized infrastructure scales commensurately, creating persistent demand. AI infrastructure encompasses the specialized hardware and facilities required to train and deploy complex AI models. At its core are graphics processing units, or GPUs, which are uniquely efficient at parallel processing, a necessity for AI's massive computational requirements. These accelerators form the backbone of modern AI compute. Beyond individual GPUs, specialized AI servers integrate multiple accelerators with high-speed interconnects to form powerful compute nodes. Networking components, including high-bandwidth switches and optical interconnects, are equally vital, ensuring rapid data transfer between GPUs within servers and across entire data centers, preventing data bottlenecks. High-bandwidth memory, or HBM, represents another critical component. Unlike standard DRAM, HBM is stacked vertically and integrated directly with GPUs, providing significantly higher memory bandwidth. This architecture is essential to feed the enormous data demands of AI models, preventing processing units from idling due to memory access limitations. The physical environment for AI compute is also part of the infrastructure. Purpose-built data centers house these powerful systems, requiring specialized design to manage the extreme heat generated. Advanced power distribution and cooling systems are indispensable, with liquid cooling solutions becoming increasingly prevalent to maintain optimal operating temperatures. The AI value chain begins with chip manufacturers like NVIDIA, designing and producing the specialized GPUs and related components. These companies invest heavily in research and development to push the boundaries of computational performance and memory integration, setting the pace for AI advancement. Next in the chain are equipment suppliers, providing the specialized manufacturing tools and testing equipment necessary for producing these advanced chips. Networking companies also play a crucial role, developing and deploying the high-speed interconnects and fabric architectures that link thousands of GPUs into cohesive supercomputers. Cloud providers, often termed hyperscalers like Microsoft Azure, Amazon Web Services, and Google Cloud, occupy a hybrid position. They are immense consumers of AI infrastructure, purchasing vast quantities of GPUs, servers, and networking gear, which they then offer as AI as a service to their global customer base. Finally, at the application layer, AI developers and enterprises leverage this infrastructure to create and deploy AI models for diverse use cases. This includes everything from large language models and computer vision systems to scientific simulations and autonomous driving algorithms, representing the ultimate output of the AI value chain. The distinction between AI infrastructure companies and big tech is clear. Infrastructure firms predominantly sell the hardware, components, and foundational services required for AI development and deployment. In contrast, big tech companies are the primary purchasers of this infrastructure, utilizing it to build their own AI services and products. Infrastructure companies are currently winning due to an unprecedented surge in demand for AI compute, driven by the rapid evolution and adoption of generative AI. This explosive growth has created significant supply bottlenecks for specialized hardware, particularly GPUs and HBM. These persistent supply constraints have bestowed higher pricing power upon the infrastructure providers. With demand outstripping supply, these companies can command premium prices, leading to stronger cash flow returns on invested capital, or CFROI, compared to many downstream AI application developers. The CapEx story highlights this dynamic. Major hyperscalers like Microsoft, Amazon, Meta, and Alphabet are collectively spending hundreds of billions of dollars annually to build out their AI compute capacity. These investments reflect a strategic imperative to remain competitive in the AI race. Investors are closely scrutinizing this massive capital expenditure, especially its relationship to free cash flow. While CapEx is essential for growth, sustained high spending without commensurate returns raises questions about the efficiency and eventual return on investment for these large tech firms. This scenario mirrors the historical picks and shovels strategy during the gold rush. While many prospectors failed, those who sold tools, provisions, and transportation consistently profited. In the AI era, infrastructure providers are the picks and shovels suppliers, enabling the gold rush without bearing the direct risks of individual AI application success. Despite massive investments, several AI bottlenecks persist. High-bandwidth memory shortages remain a critical constraint, limiting GPU deployments. Furthermore, the specialized networking hardware, particularly advanced optical interconnects, struggles to meet the escalating data transfer demands of colossal AI clusters. Data center capacity itself is becoming a bottleneck. The sheer density and power requirements of AI hardware necessitate new designs and extensive power infrastructure. Furthermore, the massive electricity consumption and the consequent need for advanced cooling solutions, including liquid cooling, present significant challenges for expansion. Investing in this sector carries inherent risks. A potential slowdown in AI CapEx from hyperscalers could impact revenue growth. Future oversupply of certain components or increased competition might erode pricing power. Valuation risks are also present, with some segments showing elevated multiples, leading to concerns about an AI bubble. The key investing lesson lies in identifying second-order winners. These are companies that enable the primary beneficiaries without being directly exposed to the same competitive pressures or valuation risks. Investing in the foundational ecosystem, such as chip manufacturers or specialized component suppliers, can often outperform direct investments in the headline AI application companies. NVIDIA, Micron, and Marvell exemplify companies within this critical infrastructure layer.